Good afternoon, everyone. My name is Ivo Mulder, and I work at UNEP Finance Initiative, based in Geneva. UNEP FI is a public-private partnership between the UN Environment Programme and the financial industry. We've got about 230 members, mostly commercial banks, also development banks, fund managers, and insurance companies. And over the past 2 years, I've started a project called the Natural Capital Declaration, which is trying to articulate how natural capital is relevant for the financial industry. It's a pleasure to moderate today's session. Let me start by introducing the panelists. On my left, I've got Ben Ridley, the Head of Sustainability Affairs at the Asia Pacific region for Credit Suisse. Next, Johannes Ebeling, Vice President Biocarbon from Australia. Johan Clare, Global Business Development at Veolia Water. And last but not least, Rosemary Bissett, the Head of Sustainability, Governance and Risk at National Australia Bank. So quite a diverse panel. And the objective is basically to understand of how natural capital is relevant for the financial industry. And I think what is interesting by having Johan Clare from Veolia Water is how this would also be of relevance to, for example, your finance department within Veolia Water, or for a small and emerging company like Biocarbon, how you look at it from a business development perspective as well. Many of you may wonder, like, how is it actually relevant? Because most financial institutions are quite far removed from where natural capital is actually impacted through your clients. And I think what we would love to hear is how this is actually practical or made practical within the institutions that are represented today here. So can I ask first, Ben, can you explain what your role is within Credit Suisse, also a bit about the size of Credit Suisse, and then last but not least, to what extent in your personal opinion, the financial industry is currently integrating natural capital in both risk management and perhaps also going towards, business development. I think it's working otherwise.
Can you? Yeah, you can hear me. Great. So, hi everyone. Good afternoon. My name is Ben Ridley. I'm an ecologist, actually, by background, an environmental scientist. I work with Credit Suisse. I'm based in the Hong Kong region, in the Asia Pacific region. And I've been in the region working on environmental and sustainability issues now for 20 years. So I thought I should mention about the fact that I'm an ecologist, so I do have a little bit of traction with this issue, but also like to be clear that I'm not a banker. Most people working for banks are not actually bankers, and that's the truth. Most of them are in IT. I'm not joking. So I encourage my children to pursue IT as a profession. In terms of what I do, I deal with environmental social risk issues. So I conduct due diligence on our clients. That's largely clients that are in upstream sectors, in terms of prioritizing where we want to look, in terms of where environmental and social risks lie. It's looking at agribusiness, so clearly oil palm we've heard quite a lot about in the last couple of days. It's rubber, it could be sugarcane. It's also mining and oil and gas. So in terms of the sort of commodity areas and the number of sort of products that they produce into many different sectors. That's what we look at. So we approach sustainability really from a risk management proposition, which I think you could look at it and you can argue, well, that's a little bit primitive because sustainability is equally about risk, but it's also equally about opportunity. So we do a lot of work in the risk management space, and effectively what we're doing in transactions and why this is relevant to natural capital is because the upstream sectors, they have large ecological footprints around land use conversion, about water dependency, all of these issues. And so we have pretty clear diagnostic processes within the bank, and we need to understand the relevance of these issues to our clients. And once we have done this diagnostic, as it so happens, we naturally find that we have an opportunity there as well, because we've done a diagnostic on our clients. We have some information that is quite objectively obtained. We have a number of proprietary tools that we use to get this information, We have a lot of ongoing engagement and dialogue with a whole range of NGOs and other civic society groups. So we're capturing a lot of information on a lot of different issues by different sectors. And so we have a good sort of starting point for engagement and dialogue with our clients across these different industries. But what that then leaves us with is an opportunity to engage with our clients. And what we've been finding increasingly is our clients are very interested in understanding our perspectives and also how we can help them. So in the last few years in particular around natural capital issues, our clients have been a lot more proactive in approaching the bank and saying, well, we know this is a problem. Maybe they're a client in oil palm. They can't sort of, they can't not be impacted by the media, by the news and the concerns that many of their stakeholders have. And they'd like to be a bit more responsible and they'd like to seek help on how to sort of correct perhaps a slightly antiquated approach.
Can I probe you a bit on that, Ben? So everyone talks about the Equator Principles. I'm not sure if the audience knows about the Equator Principles. It's a set of voluntary principles that banks have developed voluntary together with the IFC about 10 years ago. And it focuses specifically on a very capital-intensive part of the business, which is project finance, the financing of roads, utilities, etc. At the same time, that usually constitutes only a small percentage of a large bank's balance sheet. During a meeting 2 weeks ago in Beijing, I had a conversation with your colleague, John Tobin, and he said, well, actually, we've also started to apply it to our wider lending book. So can you explain a bit how Credit Suisse is applying these environmental and social principles, and also maybe a specific example through a sector policy on forest or on agribusiness?
Sure. Yeah. I think you can still hear me just about. Okay. Yeah. So the developments in relation to the Equator Principles are quite interesting, and I should clarify that my role as a kind of due diligence support person, I don't sit in credit risk. I think a lot of sustainability professionals in banks, they do sit in credit risk, and so environmental and social risks may be a concern insofar as there's a linkage with credit risk and lending money and not getting that money back. So most of what we do doesn't really have a credit risk issue. We apply our policies right across the private bank and the high net worth banking space. We provide a lot of financing to clients that are high net worth individuals. There's an awful lot happening in Asia through the private banking and the corporate banking space. So it's quite distinct from traditional investment banking. And so we have a number of sector-specific policies. We have an agribusiness and forestry policy, for example. We have within that particular guidelines around oil palm. And we sort of reinforce that with some consultancy work, and as a bank as well, we joined the RSPO ourselves in 2010, following in fact a bit of fallout from a transaction that we and two other international banks had supported a client with. So we're looking at issues of land use conversion. It's a very big issue for us. We have a very strong banking franchise in Indonesia. We have good banking relationships in Indonesia on the investment banking and the private banking side. And so some of the tools that we use give us very useful information in terms of likely sort of high conservation values of concession areas prior to development. I'd say that the relationships that we have with a number of NGOs, collaborative and not so collaborative, are all very valuable in terms of giving us intelligence, because a lot of the proprietary tools, they won't capture this information. And we don't actually think that the agenda that we have in terms of sustainability risk and the agenda of the NGOs, or even the agenda of our clients, are that far disconnected. I think they're quite well aligned. In terms of a specific example, we provided a case study, in fact, to Zoological Society of London for their oil palm toolkit, oil palm guide. I think they're in the process of upgrading that. But we had a client who, really from the private banking side, was looking to make an investment in oil palm in Sumatra a few years ago. They were particularly interested in understanding what they needed to do in terms of conducting a gap analysis to identify where the target assets were via the environmental social risk issues. So we helped to write the scope of work. We based it entirely on the RSPO P&C, but we helped them to choose a consultant. The feedback from them was, well, that was great. So you could look at that and say, well, that's not huge value add, is it? but I think from the client's perspective, it actually was.
Okay.
And I think there's a lot of very easy solutions, just connecting clients with collaborative NGOs, sort of good consultants, good certification auditors, that can actually bring a lot of value to clients.
Thanks very much for that, Ben. Johannes, you've also been in this space for quite a few years in different capacities. Can you explain a bit what biocarbon is, what your own role is within the company, and how this topic of natural capital, which actually sits at the heart of your company, biocarbon, and maybe you can provide a specific example of one of the investments that you're working on or that biocarbon has already done for the audience.
Okay. Are we on both microphones? Okay. I won't start by saying that I also studied ecology and things like that before I slipped into finance. So maybe we should do a poll later on. So biocarbon is a very small investor compared to the others on the panel here. Invest into land use-based carbon reductions. It's its own company, actually registered here in Singapore. Was established originally by Macquarie Bank out of Sydney. That raised investment from Global Forest Partners, it's a large timber fund manager, and the IFC, the World Bank, in 2011, 25 million as a first capital raise to invest in what then looked as a great business opportunity, RED, reduced emissions from deforestation, and still is a business opportunity, but the regulatory framework didn't keep up with what the expectation was. So we're now focusing increasingly on voluntary markets for that, so companies that have a very publicly facing commitment in terms of carbon management, and also companies where we're trying to see how carbon can be integrated into supply chain management. I'll give an example on that later. And then we also have diversified into clean cook stoves and things that have to do with land use management and have very, very real additional benefits in terms of natural capital and social capital. So if you look at forests, obviously you know about biodiversity, soil, water, all of these benefits apart from greenhouse gas emission reductions. And on the cook stove side, also the forest conservation, but of course a lot of indoor air pollution, health benefits, time spent collecting fuels, a huge gender component and so on. So that goes a bit beyond natural capital, but maybe that's the next frontier of accounting. In terms of an investment example, so I mentioned the supply chain angle to carbon and products that have a direct impact on land use change. One of our investments is in Peru. It's a Brazil nut conservation project. So it's a forest of around 300,000 hectares that's protected with a local partner, collaborating with a federation that they set up, a federation of smallholder concessionaires, 400 families that produce Brazil nuts, and they only grow in natural forests. So it was very difficult for those families to maintain the forest with very low returns, based on a local market, heaps of intermediaries, and very strong land use pressures from a new highway cutting through the Amazon from Brazil to Peru. And with that investment now, there is first of all institutional strengthening, organizing all those in a federation, and then investing into production facilities that upgrade the product quality to an extent that it can be exported.
And so what is the size of the investment? Is it like 3 million? Is it higher? Are you taking an equity stake? Are you providing debt? Can you elaborate a bit more?
Yeah. So it's in around that range.
Okay.
There, as a first investment, so it was really a catalytic investment. There's then, obviously, revolving funds around the carbon credits that are generated and sold. So we have an ongoing engagement in that. Mm-hmm. It's I guess you could call it equity-like. We didn't take an equity stake in the company, but in the project. So we have a project finance structure around that.
Okay.
And then the integration, of course, into agricultural supply chains that I mentioned comes then from a product that has very significant additional greenhouse gas emission benefits and biodiversity benefits and social benefits that can all be quantified. We're working on the social part, but the biodiversity and the carbon part can be very well quantified. And I see that as an example where you look beyond the carbon and really have almost a landscape approach. I think landscapes were discussed here earlier on, and it's often quite a vague concept, but I think something like that can really demonstrate how it can come together and create natural capital that we all hope will have a real market value.
But in this case, like the landscape approach needs to become concrete on the project level for a company like biocarbon, or no? That's the only way how it can work in practice, I guess.
Yeah, so there are discussions in places like Warsaw that are of course,
Far
slowly
removed.
advancing,
Yeah.
around jurisdictional level accounting.
Yeah.
So RED was obviously conceived as a national or at least provincial accounting principle, and has faced a lot of governance challenges, and I think will be very difficult for private investors to put money into that in terms of the counterparty risk if it's government mediated. We've had some experiences in that ourselves that I didn't choose as a case study.
Back to that, maybe.
But that can be a broader landscape as well.
Thanks very much, Johannes. I think what is also interesting, because one of the things that Unify works on as well is RED Plus, and everyone wants more money to go into RED Plus to provide a financial incentive to keep for standing. But I think what is interesting from the example of a company like Biocarbon, that without the regulatory environment, it's necessary for a company to shift its business model to a more diversified approach of how you can invest in sustainable forest management with a range of revenue streams. Thanks. Johan, some people may wonder why you're actually sitting on the panel as an engineer working for Veolia Water. I mean, we briefly discussed it before. Veolia may to a certain extent also be dependent on raising external funds through corporate bonds, through loans from banks. And I think what would be specifically interesting for this panel is to hear what are some of the challenges that you think Veolia faces, or Veolia Water faces, integrating natural capital on your balance sheet, because that's one of the topic of the conference. That means, of course, that you need to have a meaningful discussion with your chief finance officer or the people working in the finance department, which who often have a different educational background. They have a different mandate within the company. So can you explain a bit about, well, first of all, your own role within Veolia Water, and then also the link to finance?
Yeah, I think it's our balance sheet, but it's also the balance sheet of our customer, and so I will explain that also.
Yeah.
And so I'm very pleased to be part of this panel, and I think this forum is a fantastic place to connect different worlds. And even if I'm an engineer, I can be part of a panel with banks and insurance company like we had before. So that's fantastic. Veolia is a global company that is providing best-in-class technology and services to tackle the most pressing challenge in terms of water, in terms of energy, in terms of waste and resources. And maybe I can share the journey we went through. You know, during this forum, it's clear that we hear a lot of time that the technology are there. Technology are theirs, but the challenge that we face usually is to engage the people and really to be able to demonstrate a true payback of some of the technologies. And sometimes when we're working with industrial leaders in the mining, oil and gas, power, or food and bev and cosmetic, that's truly a challenge to engage the chief financial officer. And if I'm taking just one example, we've been working with a beverage company, fantastic CEO, taking big commitment in terms of reducing the water footprint. Why? Because it's important in terms of leadership, it's important in terms of maybe risk management, but also for his brand. So we work with the sustainability people, we start to map the different risks, we work with the global operation, we come up with a solution, but then water is priced at, let's say, $1 per cubic meter of water. And so depending on the technology you want to implement to reduce the footprint, then the payback is 20 years. So you go to the CFO, they say, well, guidelines, payback 3 years, out. And so we're facing sometimes this problem. And so the idea is really to try to map the different risks. And we had some discussion about should we put a price or value of nature? Maybe it's dangerous to put a value of nature, but to put a cost, to monetize risk, that might be the way forward really to engage. And so that's the risk dimension, and what we're trying to do is to show the opportunity to our chief financial officers, and the opportunity will be maybe to improve your insurance premium. That would be also, you know, we start to see companies, rating agencies like Moody's or Standard & Poor's, looking at water, for example, in the mining sector. So you can really demonstrate, you can improve your rating. That would have a fantastic impact on the cost of capital. So that's really the way we're trying to engage. But once again, we really need, I believe, to monetize the risk.
So just to add on that, if I understand you correctly, so I think one of the issues is the price of water. So if water wouldn't be if water would be more expensive, it would be easier to have a conversation with the chief financial officer, because the payback time may be a bit shorter than it would be at the moment, where water is too cheap in a way, and talking with clients, and the payback time would be too long. Is that
The idea is not to increase the price of water or to give a value of water. I think it's when people are calculating net present value on reuse solution to save water, usually in the models they're using the freshwater price. So what we say is that there are externalities around water and risk. That's what you need to take into account. Maybe you come up with a sort of true cost of water, for example, but that's really not the true value, or increasing the price of water for municipality. That's really not the purpose. And I'm sure a lot of people in the room will fight against that, which is fair, but it's really monetizing risk.
But that sort of process is starting to hit home with the credit rating agencies, isn't it? I mean, I recently saw a piece of research from Moody's, which is one of the 3 main credit rating agencies in the world. I think this piece was specifically for mining, I believe in Chile or in another Latin American company, where they say, well, the water scarcity may become an operational issue for a mining company, and that could hit its revenue model, and therefore also the credit rating that we attach to this company. Is that the way how, through the risk angle, you could sort of hardwire the environmental component in visualizing the value for a company like Veolia Water?
Yeah, I think that's really the idea, really push into the corporate social responsibility world. But for sure, you've got companies that are going to invest because they want to showcase their stewardship. But if you really want to scale, you need really to be able to show that you can maximize profit by tackling some societal challenges. And so the CFOs, they start really to understand that when they start to price, what will be the impact on my cost of capital because of the rating, what will be my impact if I can monetize the risk of loss of social license to operate, what will be the impact if I don't have a license to go, so meaning new permits to get some processes. And so by really trying to monetize that, that's the way we start to engage people.
Okay. Thanks very much. Rosemary, we've been working quite intensively over the past 2 years. Can you explain a bit what your role is with National Australia Bank, and also for those who don't know what National Australia Bank is in terms of its size, where it operates, and how the topic of natural capital is relevant for your bank?
Okay. Well, we're mainly operating in developed countries, so we have about 42,000 staff. We've just announced our full year results, and we announced we had 4.94 billion cash earnings. We're about the 17th, I think, by market cap globally. And our operations are in Australia, New Zealand, the UK, US, and there's a small number of mainly representative offices across Asia, with the centre of that being Hong Kong. Next biggest in Asia would be Singapore, so here. What is not known about NAB, but is known about Rabo, one of our key competitors, is that we're actually, alongside Rabo, probably fighting for number 1 and 2. Depends on the day, I think, which one maybe is number 1 for who's the biggest Agribank in the world. So we bank a lot of agricultural customers in New Zealand, the UK, Australia, the US. That means natural capital makes sense, and signing the natural capital declaration, which NAB did alongside Rabo as the 2 inaugural signatories to it, makes a lot of sense when you're banking agricultural customers who are exposed to natural capital risk in developing countries, and Australia is one where you see bushfires, water risk, drought. So you've got a lot of exposure there, weather events. It makes sense, and so our agri-bankers are intuitively getting this as we talk to them more and more about it. So my role, I sit in risk. We have teams that work on environmental and corporate responsibility things in different parts of the business. So we have a corporate responsibility area which sits in our people, communications and marketing area. My team sits in enterprise risk, now in the credit risk team more recently. But we have a wider purview, so we coordinate the environmental agenda across the group. That has 3 key areas of focus: climate change, resource efficiency, and what we call natural value. So it's taking natural capital to the valuation piece, because the end game is to be able to price risk properly, so we manage it properly. And then risk is a two-sided coin. If you understand the risks, then you can see the opportunities. And we believe that opportunities will come to help our customers as we understand the risks. And then we have some people within our strategy area. So natural value or natural capital was identified as a horizon strategy issue right at the top of the organisation. So, you know, up there were with ageing population, the digitisation, all of those issues. About 18 months ago, natural capital risks or natural value was put up there as a potential systemic risk that if we don't look at it and manage it, could actually be a serious issue for us as a bank. That means now we actually have 2 people, job sharing, working full-time on supporting our natural value agenda, as well as the resources in my team as well. In terms of a risk perspective, our role, so as well as walking across the group on our environmental agenda and coordinating with the businesses that we've got in the different jurisdictions, we've got a job helping across our risk categories. And in banks, you've got market risk, non-traded market risk, credit risk, operational risk. You've got all these risk categories. And so our job is to support the guys who own those risk categories and to help them think about how environmental, social and governance risks play out in their various risk categories. And natural capital risks form part of the E in that ESG risk profile. And then particularly with credit, it's about how we look at and perform the due diligence on our clients. So similar to what Ben was saying, and I'll actually add to the science backgrounds up here. So I have a biology with quite a lot of ecology and chemistry background. So I'm not a banker either. So don't come and ask me for money. I'll encourage the bankers to talk to you about the money though. But working with the bankers to help them understand when they're looking at the due diligence on their clients and they're undertaking the risk assessment, what these risks are. And, you know, we're at the beginning of that journey. It's not like anyone's got a golden kind of solution to it. So understanding the impacts that different sectors bring. So we've gone through all the ANZIC codes, Australian, New Zealand industry, standard industry codes. Britain has a set, the UK and the US have sets. So we've gone through and qualitatively we know which sectors are likely to pose the greatest risks for natural capital.
Can I stop you here, Rosemary? Please have some questions ready for the panel. I will do one more quick round of questions to the panel, but it would be great if you have a few questions of your own that you can think of in the next 5 to 10 minutes. So Ben, I mean, one thing that strikes me whenever I travel to Asia is the enormous pace of development. And I recently read an interesting piece by Standard & Poor's that showed that the expected amount of outstanding corporate debt is portrayed to grow twice as fast in Asia in the coming 5 years as in Europe and the US combined. So I'm from Holland and Europe myself, and I see that the financial industry is struggling. At the same time, you see Asia really powering ahead. At the same time, when I read the Team for Business Coalition and Truecott's report on natural capital at risk, I see that the challenges in terms of natural capital degradation in various private sectors are quite profound. To what extent is Credit Suisse able at present to work with clients to mitigate risk and also to identify the potential to attach environmental factors to non-performing assets? Is that already possible now? Will it be possible in the next few years? Is that something that you or your colleagues within Credit Suisse look at? Because I think on the one hand there's an enormous appetite to expand the business, which is a natural phenomenon as a bank. At the same time, the stakes are getting higher with or without government intervention. So how do you see that?
Yeah, I don't know what the sort of, although the debt sort of rate may be doubling in Asia, I don't know how it compares in absolute terms with Europe.
In absolute terms.
You know,
In
okay.
absolute terms, it will be expanding twice as big, or at least
Yeah.
that's the expectation.
Yeah, we don't have a systematic approach, you know, in terms of certainly on the credit risk side of quantifying that risk in relation to natural capital with our clients. That being the case, it would suggest that we don't see it at the moment as being a huge concern. We still think actually that there's a lot of opportunity, and that the opportunity is probably greater than, well, the opportunity upside, the potential is rather greater than the risk. I think the risks are quite well understood around particular sectors, particular issues. They are not new. There's more of them, but I think it's quite well understood. I think there's increasing opportunity for engagement and for banks to, you know, really proposition sustainability issues management as something that is to the benefit of the clients. So I think, you know, that's the kind of space that we're moving into. I think it's really at that point that we'd like to see a lot more of the Asian banks moving into this space as well. We don't think it's really a competitive situation. I think that there are probably too few banks in the region who are really taking environmental social risk issues seriously. So we need some way of kind of selling this more. I think if the institutions feel that environmental social issues are purely just sort of risk management concerns, the agenda isn't going to progress. So I think the time is now for, you know, really a different kind of discussion with our clients and for other stakeholders to support that discussion.
Okay, thanks. Johannes, do you have any deals? I mean, you mentioned one deal that you elaborated on in the first round. How many deals has Biocarbon closed, and are any of these in the Asia Pacific region?
Yeah, so it's a good half dozen in total. There is one in the Asia Pacific region in Indonesia that's not very active at present because of governance challenges, and that, you know, speaks again to the challenge of, you know, getting a regulatory buy-in and penetrating a complex governance situation in those jurisdictions. So RED at some stage actually, you know, despite now being a voluntary initiative at some stage, you know, some countries actually stepped forward and put in place regulations that you would hope, you know, clarify the playing field and set clear expectations, but they also provide a lot of opportunities for different people to.
So if you would provide sort of one barrier or one solution, what would it be in order to sort of scale up investment by a company like Biocarbon? Would it be regulatory certainty about a carbon price, including a carbon price for RED+? Would it be something else? Can you think like about one or perhaps two factors that you really think like those are key to driving our business model forward? Yeah.
So you mentioned one of them. Okay. So regulatory certainty on a carbon price and on a regime actually existing that sets a carbon price. Doesn't even have to be a global level, but could be something like California actually providing certainty that RED credits are going to be allowed in their scheme. There's a provision for that, but it's not expected to be decided anytime soon. If that was in place, our three investors, for example, Macquarie Bank, GFP, and the IFC, would obviously have the capacity to put in a lot more resources to scaling up that business. So the carbon price would be one. The other one would be certainty of demand for carbon credits. So right now we have a situation where a lot of government agencies, a lot of companies pay for inputs basically into sustainable development benefits or into natural capital management or protection without necessarily being too focused about the outcomes. Whereas if you looked at carbon credits with very well understood co-benefits, biodiversity, social development, health and so on, you'd be able to actually pay for results without any risk taking on the part of the buyer. So if some of the ODA, for example, some of the multilateral funds, some of the CSR funds were actually put into results-based programs, that would reduce risks for those off-takers, and it would allow a lot of private capital to step in and provide those results.
Interesting solution. Johan, I want to get a bit deeper into this issue of risk. I mean, you said as a water engineering company, the issue of price of water is always there, but increasing it may not necessarily be the solution. You said one opportunity would be to price the risk of water into the business model. Can you I mean, you also mentioned credit rating agencies and as one possible way forward. Also for you, I mean, what do you think if you would have to mention like one actor or one factor that could really provide a clear signal to, for example, your CFO or your finance department that these issues are real?
You know, I've been working on carbon issue also, and within the water business, and water is a lot easier because we've got hundreds of examples where water challenges have already impacted the bottom line. So when we discuss with some customer, it's quite easy to find an example where they have really big damages of the bottom line. So, you know, everybody is talking about water shortages, but recently in Australia, in Queensland, the flooding, I think the impact for the coal mining sector has been 2 billion, you know. In South America, there are a lot of companies that are currently losing their social license to operate. So everywhere where you look, you are already a lot of examples related to water. So that's the first step. But then after it's to see, well, it's to discuss the probability if it will happen again, and also try to size the impact about that. But people start to realize that it's there, and so that's why now we have more and more inquiry about this topic.
But is there sort of a process happening within Veolia Water to try to address this in a more systematic way? Because at the moment there are a lot of anecdotes. Yeah. Is there an interest from the top management to see how this could be more systematically integrated, or is that still one step too far at present?
I think for a company like us, you know, a bunch of engineers sometimes can be very frustrated when you hear about all the big challenges. You know that you have the technology there. So for us, it's a way to market differently the added value of what we offer. And so our CEOs, our top management, this is the kind of stuff they currently discuss with board members of leading mining companies, but also leading food and bev companies. And so this is happening once again. But the challenge is really behind the risk to demonstrate the opportunities. So this is where we need further to engage the financial community, the insurance company, because if you are able to demonstrate that you have a better risk management and improve your insurance premium, then that's going to impact your bottom line now, not in 20 years.
Are you getting any signals from investors or not at all? Because it's indeed one of the signals that could sort of trigger that change within your company. And I always ask these sorts of questions in a panel discussion. I'm also interested in hearing the answer of it.
We are a lot of more and more inquiry for capital ventures, but now we start to meet with some insurance company or banks or also rating agency that wants to learn. And I have to say, sometimes when you look at the data or the metric that is currently used, it's a bit scary. But the fact that we are entering this discussion and that now, you know, we have that kind of forum to exchange, I'm a true believer that, you know, we are going to build some...
In the right direction.
Yeah, exactly.
Rosemary, Australia just had a change of government from Labour back to the Conservatives. That's, of course, having a direct impact in the climate change legislation and laws. How does a bank like National Australia Bank deal with the emerging risks of natural capital, whether it's water scarcity or perhaps even too much water, and also weather extremes on your loan portfolio? And if you would mention like one or two key factors, how could it be further mainstreamed within National Australia Bank? Is that systematic buy-in by your CEO or senior management? Is it voluntary initiatives like the Natural Capital Declaration, or are there other factors that you see as more key, for example, financial regulators moving?
Okay, in terms of, because there was 3 questions I think there. In terms of how do we cope with the evolving or emerging risks that are related to natural capital, and water risk is a classic. Understanding which sectors are vulnerable to that, and the agribusiness is definitely key to that, and it's not just in countries like Australia. If you jump across the ditch to New Zealand, in March this year, Wellington basically announced it had 20 days supply from one of its main, or a few of its main reservoirs for the city. And farmers there, which are, as I said, our agri customers, were actually going into financial hardship. So actually understanding which of those customers can be facing water risk and helping them to understand how to manage it is critical. And I don't think many people realise it, but the finance sector and banks actually do a lot of, if you like, hardship support for those customers, because they're long-term customers that are trying to cope with the vagaries of the environment. And in a country like Australia, although climate change makes drought worse, drought has been part of the landscape or the environment for a long period of time. Now they're just getting longer and harder. So helping your customers to survive through that is critical. That means we extend things like interest holidays and all sorts of things, so you become a quasi social service provider to some degree, if that makes sense to people. So understanding which sectors have that risk, understanding which parts of the agri sector are potentially more risk than others may mean that some parts of that sector you have to say, we can't afford to bank that because the default risk is too high. But the aim of the game is to help your customers and build their capacity and resilience. And I think understanding natural capital and working through the natural capital declaration process gives us an opportunity to understand the risks and dependencies our customers have, look at the tools and methodologies we can use to understand that better, and then think about the metrics that we can use to track what our customers are doing, have the conversations with them so we can actually show them where there's examples in their sectors of best practice management, which makes them more resilient businesses. Because the aim of the game is that banks want those customers to be there for the long term, and particularly in the agri sector, they're long-term customers. So your second question, I think the standardised methodologies and tools, and potentially in the long term, you need to create the level playing field to get real long-term mainstream change in banking. It'll need regulatory reform.
Right, so you need regulatory reform in order to create a level playing field. It's not through voluntary initiatives, I guess, that you can ever create that.
And you're seeing that in some developing countries, like Nigeria. We heard about that during Sustainable Finance Week, where the Nigerian government's actually worked with the finance sector and they've got sector guidelines and they're really starting to put in some regulatory rules around what banks do.
I think it's working.
Okay. Yeah, maybe just to sort of add a perspective. I agree. I think the regulatory part would be certainly more convenient. It would take away a lot of the pain. I think a lot of the banks would welcome that sort of leveling of the playing field. But I also do think that, around particular sector initiatives such as, for example, RSPO, where up until now there haven't been any Asian banks involved. There's an awful lot of players in the oil palm industry. I think the RSPO membership is now several hundred. So if you took all of those players that are RSPO members and they demand from their banks that their banks join RSPO, for example, I think there are things that could be done to actually advance the level playing field argument a little bit more. But I do think that regulation is...
So it's both, the regulators and also a level playing field, for example, on a commodity or a sector level, for example.
Yeah, I think a degree of convergence. Yeah.
Okay. Any questions? There must be questions from the audience. I see a hand over here and a hand in the back. So maybe start in the back first. Can I get a microphone there?
Hi.
Can you also please introduce yourself and also to whom you address the question?
Great. My name is Sheng. I'm from CDSB, Special Project CDP. Couple of questions. One, could you describe a red line such that when we cross it, we won't choose to finance or invest in a project? What are gray areas and what are blue lines? And lastly, what is the informational gap that banks and a company like Biocarbon face right now in terms of financing and investing?
Okay, I understand red lines. What do you mean with blue lines?
Blue lines are the completely opposite, such that when we cross it, we automatically invest or finance.
Okay, thanks. I'm taking two more questions before I address it to the audience. I've got a question there, gentlemen.
Hi, Steve Peters is my name from Stratcom. My question's for Rosemary. Rosemary, very nice to hear that an Australian bank is one of the largest commodity banks in agriculture, but you said that you have 2 people in your team. Could you just clarify how many people in your organisation, as the number 1 or 2 bank in that world, is actually involved in this natural capital process? Just a very, very quick question. Thank you very much. I thought it was excellent.
And I've got one question here in the front. Can I get a microphone, please?
Thank you. Gabriela Monsanto. I'd like to, I direct to all, and my question is, how can we talked a lot about collaboration those days here, and how can we better leverage this experience that the finance sector has in terms of risk evaluation and integration, natural capital in decision-making process, in order to integrate this in companies and supply chain in agribusiness sector, then going beyond of customers, that these are what we have been doing until now. Then how can we use your experience to integrate natural capital in decision-making process?
Right. Okay, so the first question was about red lines, blue lines. Are there any areas, perhaps specifically for you, Rosemary, and for you, Ben, where either NAB or Credit Suisse would simply not go? And also blue lines, new concept for me at least.
Sure. I try that one first. I mean, in terms of red lines, what we are looking at through our due diligence process is basically, a few things. We're looking at aspiration and commitment. What's the nature and the form of that commitment? And it comes down to a question of trust. But I think more importantly than that is a question of capacity on the client side. And we can appreciate that perhaps the client doesn't have the capacity, but if we can see the willingness that they'd like to learn, then at least we can start to think that we can influence them. And then we have a good look at what they're actually doing in terms of their credibility. So I sort of refer to this as the 3 C's, the commitment, the capacity, the credibility. And as long as around that the reputation of this particular client is not a complete disaster, therefore we feel we have some wiggle room with them, then we're going to be inclined to work with them. I think the alternative of not working with a client, even a contentious one, is that they'll go somewhere. They're still going to get financing. I mean, I use the example of RSPO because it's been topical, particularly in Singapore earlier this year with the fires. There's a lot of banks that really don't have much happening in terms of environmental and social risk standards. So to think for a minute that a client, regardless of how contentious they are, isn't going to get financing or some kind of support, it's pie in the sky. So we would always look for the engagement opportunity with a client.
Okay. Rosemary, anything to add on that?
I think I would reinforce that it's about knowing your customer, and that's the internal language.
But do you have clear red lines?
In some cases, there are some sectors which we would definitely avoid, and places where we wouldn't go. But in most cases, it's the same approach. You're looking at the individual client, and you're actually working with that client. You obviously can't manage their business for them, but you can set terms in loan covenants and other things to help manage risk, and it's about the conversations that you have to help them manage their risk as you work with them. So it's never black and white as much as everyone would like it to be.
And Johannes, there was a specific question addressed to you.
Yeah, I actually didn't catch that.
Yeah, could you please repeat the question specifically for Johannes? I think you had a specific question, or not? Okay. Rosemary, there was a second question.
About people.
Indeed. I mean,
I mentioned that we had 2 people within the strategy team that were working purely on natural value, but then they're supplemented by my team, which has had 3 people. But our role is to help as subject matter experts and then to build capacity, because basically we can't be everywhere where a banker is talking to a client. And the game in any bank, and if you ask Ben how many people are sitting in his type of role as well, it will be a small group of people. But it's to build capacity of the frontline guys so that they understand these risks. So it's smart use of the resources that we have that have the subject matter expertise to pass that knowledge on. And that's why the tools and methodologies and the standardised approaches to measuring and quantifying the risk become important, because the end game is to build this into credit pricing and credit decisioning processes.
And then the last question was about partnerships. So how, and that's addressed to the entire panel. How can the financial industry work with companies in the agricultural supply chain, for example? Can you give a specific example of where you're active and how that could perhaps be further elaborated or increased?
Sure. Again, I think RSPO is a great example. I mean, it's about as close as I get to any kind of multi-stakeholder engagement around a particular agri-commodity. There's a number. I can't stress enough the importance of sustainable certification schemes for agri-commodities. I think despite the criticism that RSPO gets, I think it's best in class. I think what they're trying to achieve is fantastic. I just like to see a lot more financial institutions get involved. I think behind the scenes around particular kinds of financing, you've seen the Equator Principles, there's a number of other things, and in fact, bank to bank, there's a lot happening. You would probably never hear about it in the public domain, but I'm working on a project with colleagues from JP Morgan at the moment around environmental social risk disclosure in capital markets transactions. There's a lot of things happening bank to bank, but maybe they're not quite in the public domain enough.
Thanks. Any of the other panelists that want to get back before we have to close the session?
Yeah, on the partnerships, and it addresses actually partly the red lines as well. So the carbon credit industry got together at some point in the past, a few years back, and actually created a standard to account and to verify externally carbon reductions created through projects and then to be used by corporates to offset their emissions. And that was because a lot of claims were being made about carbon neutrality, about benefits and so on, that weren't verifiable. And so there was a standard created, verified carbon standard. And it's similar for the Climate Community Biodiversity Alliance that was driven really by stakeholders trying to create a market or trying to preserve the credibility of a market. And on the red line that ties into that, so if a project doesn't meet those standards, we won't invest in that. If it doesn't create net positive impacts on communities and on biodiversity, both our investors and then also the markets, so our clients, don't allow us. That it's basically there's no market for a product that isn't clearly sustainable.
Thanks. Johan, do you want to add to that? I mean, the testimony that you're in the panel as a non-financial organization is already an interest in bridging that gap. But anything that you have to add to the last question, or?
Exactly that. I think once again, collaboration is good to raise awareness.
But is it too much? I mean, it's also costing time, of course, and
costing time. But what I mean is that it's about competition,
right.
Competitiveness, and so a lot of companies start to realize that, and so that's why they really start to look in the data about their risk and start to put a price on externalities to move management forward and implement solution. And it's happening now.
And partnership can be a help a way to understand how you can remain competitive in that field, or?
It helps.
Right.
But once again, it's in competition for me is the best lever to put the right energy to move forward.
Thanks. Can I get a round of applause for the panelists? Thanks. Thanks very much.
Thank you, Ivo.